Another thing that we'd love to mention are neighborhood credits for Virginia and Maryland. We picked those two states out because we figured most of your clients
Likely.
on this call would be filing in Virginia and Maryland. So they both have credits that benefit certain 501c3 charities by providing a credit to those who donate to the charities. The states give the qualifying charities a certain amount that they can give to donors as a credit on their return. So for Virginia, it's called a neighborhood assistance program. And there's a giving floor of $500 to get the credit. And the credit is worth 65% of the value of the donation. And that's for businesses and individuals.
That's good to know.
Yeah. So an individual is limited to a maximum donation of $125,000, and the credit is offered up to 65% of the donation. And so $125,000, 65% would be $81,250 in credits. And that credit is non-refundable, but if it exceeds the Virginia tax liability, it can be carried forward for 5 years. And then for Maryland, it's called the Community Investment Tax Credit Program. And again, businesses and individuals have to donate $500 or more, and the credit is only 50% of the value. And they can claim a maximum of $250,000. So that equates to a gift of $500,000. You can always give more than the maximum. However, you would only receive the credit up to the maximum.
Switching gears a little bit, but we were talking about charitable contributions earlier and how to make them go as far as possible. We talked about RMDs. So tying it back to RMDs, what about taking advantage of qualified charitable distributions? Can you tell us what that is and how that might benefit someone?
So a QCD or a qualified charitable distribution is from your IRA directly payable to a qualified charity. That actually counts as an RMD, but it's excluded from your taxable income. It must be a direct transfer of funds. So if you take a distribution and then you turn around, the next minute, write a check to a charity, that's still considered a taxable event. So why is this important? Additional taxable income may push you into, like we talked about, an increased tax bracket, and it could also actually reduce your eligibility for certain tax credits. So it's a really great way to make your money really work for you, and kind of, be able to make that charitable contribution that you want to, and also help your taxable income, help you go financially farther. So there are a few accounts that are eligible. So traditional and inherited IRAs, and then inactive plans for SEP and simple IRAs. And there actually are a few other ways to make charitable contributions that if you wanted to talk about that too.
Sure. And before, I definitely want to talk about that. I just want to make a point because I learned about this actually just a year ago, and I thought it was pretty interesting because sometimes the logistics of having to have the funds go directly to the charity is a bit of a pain in the neck, but just know that some custodians will actually let you have a checkbook on your IRA where you can write those checks directly. So I don't let everybody have a checkbook because I don't want people to start mixing their checking account checkbook and IRA checkbook and start writing checks from their IRAs. That would not be good. But if you're this organized person, just know it's possible, so that throughout the year, when you make your contributions to charity, you could use an IRA checkbook to make those contributions. So just something logistics that people may appreciate. But go ahead, Maggie. Sorry, I interrupted you.
No, that's great to know. I just learned that too. So that's definitely helpful. Makes, your life a bit simpler. So a few things that I wanted to go over for charitable contributions that would help the taxpayer. Again, so there really isn't a best way to make charitable contribution. It really depends on where you are as a taxpayer, where you are financially. So one thing that you could do if you have the money is a donor advised fund, and that's when you bundle contributions. So it's a private fund that's made up of multiple organizations and it's run by a third party. So it's similar to like a ETF where it's many things controlled by like Schwab, for instance. So you, as a taxpayer, you would make the charitable contribution directly to that fund and you would receive the immediate tax deduction, and you can recommend grants, so distributions out of that fund as you see fit. You don't have to immediately turn around and make a charitable contribution out of the fund that year. You can wait, you can do it as frequently as or as infrequently as you like. And then you can pick whatever fund that you like the contribution, you like the charities in, which is really great because, you know, it's your money and you want to control where you're spending it. So a lot of the funds have a variety of investment options to grow your money, and that the money grows tax-free. And it's really great if you ever want to transfer assets, because you can do that without getting the capital gains tax, and you receive the immediate fair market tax deduction of that. So
Win-win.
yeah, it really is a win-win. You're making it very easy for you to donate. Another thing that you could do is charitable contribution bundling. If you don't want to go through the process of donating to a fund, you can bundle. So like I had mentioned before, the Tax Cuts and Jobs Act did raise the standard deduction. So it made it a lot harder and disincentivized people to make a lot of charitable contributions to get over the standard deduction and into the itemized range. So one way to maximize your charitable contributions and really make your money work for you is to only donate to charities every few years, even as frequently as every other year. So for example, instead of making a $10,000 contribution every year, you make a $20,000 contribution every other year. And in those years, it pushes you over the limit of standard deduction. If you say a married filing joint couple, you have, you know, tax, state tax, local tax, and mortgage interest and medical expenses as well. So you can you can itemize in those years. And then in the years that you don't make the contribution, you would take the standard deduction. And it's really important to talk to your advisor, tax advisor, especially your financial advisor, to see what your finances are like for that year. If you've done a lot of sales, have a lot of gains, if it makes sense for you to
offset a good year.
Yeah, so that's something you should definitely talk to your financial advisor about to see really when it works for you. And it doesn't have to be every other year on the dot, $10,000 on the dot. If it's every 3 years, really, it's different for every person.
No, that's a great point. It's a very powerful tool, and people think it's a lot more complicated than it really is. I think, you know, you mentioned Schwab has a great one. Fidelity has a great one. Super easy. You just create an account. Everything is done online. It's so easy to just give money to the charities that you like. And it's really a win-win all around, like a tax win for you, and then a charity, even if you give them a highly appreciated security, then they get to not pay their taxes on that anyway, because they're a charity. So it's so powerful. So thank you.
Oops, sorry.
Go ahead, Maggie. Sorry.
I did want to mention one other thing about the neighborhood credits that I didn't mention before, but they're a really great tool. And for example, if you were in the 37% bracket and you donated in Virginia, the maximum of $125,000, you maximize all your deductions, you would actually save a total value of over $134 between your federal and Virginia bill, which is more than you originally donated. So your return on investment over 100%. So that really, again, depends on everyone. There are a lot of other factors, but hypothetically, you could, you know, save more than you're actually spending. So again, that's just a really great way. And there are websites that you can go on to see what charities are on there. It does change every year. I know for Virginia, you actually do need to fill out a form in order to get the credit, but it's a really great tool to use. And I think, again, like you said, not a lot of people know about it. So wanted to make sure.
And it's one of the advantages of working with a professional like you versus doing it yourself, is TurboTax is probably not going to tell you about that, right?
Yeah, there's so many credits out there. And if you Google Virginia credits, I mean, you're going to go through a long list. So always